For 5 years, a Rolex was a better investment than your index fund. Steel sports models were trading like blue chip stocks, finance bros were flipping submariners out of Telegram groups, and gray dealers were flexing spreadsheets that made it look like a watch could outperform the S&P 500. While sitting on your wrist. Rolex wasn't just a brand, it was the central bank of luxury hype. And then, almost quietly, the music stopped. The waitlist myth started cracking. The instant profit became best offer. The same flippers who swore prices only go up suddenly discovered what happens when you're holding $200,000 in inventory on a credit card. That $28,000 Pepsi GMT you saw everywhere in 2022, now you're seeing price cuts, dealer discounts, and listings sitting for weeks like expired milk. This isn't just a story about rich guys losing interest in watches. It's the story of how the luxury market got hijacked by resellers, and how in 2026 the entire gray market machine is finally choking on its own greed. To understand why this is so satisfying to watch, you have to remember how absurd the peak was. The modern Rolex frenzy wasn't just rich guys buying watches, it became a mass participation speculation game. Regular people who had never cared about movements or history suddenly spoke like experts because they watched 3 YouTube videos and joined 2 Discord groups. Steel Sports is the best store of value. This reference is underpriced. This is a safe hold. That language right there, safe hold, is how you know you're in a bubble. Because when a luxury product becomes a safe hold, it stops being a product and starts being a financial object. That's what happened. And the internet turned the whole thing into content. Watch investing channels, wrist roll videos, what I made this month flipping, how to get the call, how I built my relationship. It started sounding exactly like sneaker resale, just with older men, bigger egos, and way more debt. And the engine behind it all was scarcity theater. Rolex is famously conservative, famously controlled, and famously allergic to making it easy. Authorized dealers didn't just sell you a watch, they sold you the feeling that you were chosen. The phrase that defined the era was 4 words: I got the call. Think about how insane that is. A grown adult spends thousands of dollars, and instead of acting like a customer, he acts like he won a prize. He posts it like an engagement announcement. After 2 years, it finally happened. Blessed. Hard work pays off. Bro, you bought a watch, but that humiliation ritual was the entire business model. The dealer wasn't selling metal. The dealer was selling access. And once a company trains people to beg for access, the product becomes irrelevant. The experience becomes the value. The waiting becomes the value. The rejection becomes the value. Because rejection makes the acceptance feel like status. So you got this weird, modern, feudal system. The authorized dealer is the castle. The watches are the land. And you, the customer, are trying to prove you deserve a slice. Want a sub? Great. First, buy some jewelry. Buy a date just for your spouse. Buy a bracelet you don't want. Build your purchase history. Stop asking too many questions. Be nice. Don't look desperate. And maybe one day you'll be rewarded with the privilege of spending more money. That sounds ridiculous, but it worked because it was backed by one thing: the gray market premium. People tolerated the humiliation because everyone knew the math. If you somehow got the hot model at retail, you could flip it tomorrow and instantly win. That premium turned dealers into gatekeepers, turned customers into applicants, and turned the whole category into a speculative ladder. And then the flippers arrived. Not collectors, not enthusiasts. Flippers, the middlemen, the guys who didn't love watches, they loved spreads. Their entire personality was, I can source. They posted stacks of watches like a drug dealer posting cash. They used the same lines every bubble uses. Price firm. Last one. Market is crazy. Going up? This is the new normal. And if you're wondering why this triggers the same satisfaction as the sneaker crash, it's because it's the same type of villain. Someone who contributes nothing, adds no value, and then acts like a genius for extracting a toll from everyone else. They didn't build the watch. They didn't innovate anything. They just stood in between. That's it. The Rolex bubble created an entire class of adults who thought they were entrepreneurs because they were flipping other people's products to other people with FOMO. But it gets worse because, like every modern bubble, it wasn't just greed, it was leverage. There were levels to this pyramid. At the top, you had real whales, people with real money. They can buy what they want whenever they want. They don't panic sell, they don't need to exit. They're basically immune. Under them, you had the relationship buyers, the guys who played the authorized dealer game, got access to retail, and flipped selectively to fund the hobby. That group actually understands the ecosystem. Then you had the biggest group, the fragile group, the group that always gets slaughtered when the tide turns, the new entrants, the people who got pulled in by content and saw watches as a smart move. They jumped in at the top of the market, not with cash, but with credit, with loans, with inventory financing, with the same logic you hear right before every bubble pops. It's fine because I can always sell it. That sentence is how a hobby becomes a trap, because the moment prices drop, the easy exit turns into a locked door, and suddenly you're not holding a luxury watch, you're holding a debt-backed asset bleeding value. Now, if you're Rolex, you might say, none of this is our problem. We make watches, people pay what they pay, the market decides. But the reason this bubble got so large is because Rolex benefited from the chaos even if they didn't directly create it. When gray market prices explode, it reinforces the myth that Rolex is special, that it holds value, that it's the safe luxury purchase. That mythology pulls more buyers in, which pulls more money in, which fuels more attention, which fuels more scarcity, which fuels more premium. It becomes a feedback loop, and once a luxury brand gets addicted to that feedback loop, it becomes extremely hard to stop it because the hype itself becomes part of the product. And here's the part that most people miss. This wasn't just people love watches. This was a macro era phenomenon. For years, money was cheap, asset prices were high, and flex culture was at full volume. Crypto made people feel rich overnight. Stocks ripped. People had the wealth effect. Even when they weren't truly rich, they felt rich. And when people feel rich, they buy symbols. A Rolex is a perfect symbol. It's visible. It's universally recognized. It fits every success fantasy. It's Instagram proof. It's the easiest way to tell the world without saying a word that you're winning. That's why the bubble expanded beyond collectors into regular people chasing identity. Watches weren't just nice. They were status tokens. Then reality changed. And the reason 2026 feels like the real turning point is because bubbles don't pop when everyone agrees they're bubbles. They pop when the marginal buyer disappears. The marginal buyer is the last person willing to pay the premium. The person who walks in and says, sure, I'll pay it. When that person stops, everything collapses. Because the premium was never stable. The premium was confidence. And once confidence cracks, prices don't drift down politely. They gap down because everyone who was investing suddenly realizes they were just holding inventory. This is where the schadenfreude really kicks in, because the crash isn't happening in a dramatic explosion. It's happening in slow motion humiliation. You can see it in the language. In the boom, the gray market talked like a stock exchange. Price firm. Won't last. Going up next week, in the bust, the language flips into survival mode. Motivated seller. Open to offers. Need gone. Taking a small loss. Let's make a deal. And that shift matters because luxury premiums don't die from math. They die from psychology. When buyers believe prices might be lower next month, they stop paying today. They wait, and waiting is poison for a market built on FOMO. FOMO only works when you think tomorrow will be worse. The second you think tomorrow will be better, the bubble starts bleeding out. Now let's talk about the real villains in this story, because the title says Rolex, but the collapse is bigger than one brand. The collapse is the luxury flipping ecosystem. The gray market didn't just serve demand, it manufactured it. It taught people to treat watches like lottery tickets. It created a content machine where every video looked like an ad for speculation. Top 5 watches to buy now. This model is underpriced. Rolex is the safest asset. That content doesn't exist to educate you. It exists to recruit you because the flippers and dealers need you. They need fresh buyers. They need liquidity. They need someone to dump inventory onto. And the most dangerous part is how it reshaped behavior in normal people. It made people feel like they were missing out on a smart move. It pulled them into spending money they shouldn't spend because the story wasn't luxury, it was opportunity. That's exactly what the sneaker bubble did. The product becomes secondary. The flip becomes the reason. But here's what finally killed it. The supply-demand illusion broke. In bubble, there's always a story that explains why supply will never catch up. Rolex never makes enough. Waitlists are years. You can't get these. But when the market turns, you suddenly learn what was real scarcity and what was manufactured scarcity, and a lot of it was manufactured. Not necessarily by Rolex, but by the distribution system and by flippers hoarding supply. When demand was roaring, everyone could pretend this was impossible to get. When demand slows, watches start appearing, inventory starts surfacing, people who were holding 5, 10, 20 pieces start dumping, and dealers who were acting arrogant 6 months ago start getting nervous because their backroom becomes a liability. If you're sitting on inventory and the market is sliding every day you hold it as a loss, and the authorized dealers, the same ones who acted like kings, are now in a weird spot, because in a hot market, the dealer can behave like a gatekeeper. In a cooling market, the dealer becomes a seller again. The power flips. The customer starts acting like the one with leverage because the customer can simply walk away. That's why the I got the call era is dying. Now it's the dealer calling you. And this reversal is what makes the crash so emotionally satisfying to the audience. It's not just prices dropping, it's arrogance collapsing. Here's the part you might not want to hear if you're deep in watches. Rolex itself might be fine, even if the gray market is dying. The brand will still sell watches, collectors will still collect, whales will still whale. But the speculative layer, the hype layer, the Rolex's guaranteed investment layer, that layer is being burned off. And that's the layer that created the absurd premiums, the toxic behavior, and the content-driven flipping economy. In other words, the crash is not the death of Rolex, it's the death of Rolex as a stock, and that death is going to create casualties. Because a lot of watch businesses were never businesses. They were momentum trades. They were men who turned their Instagram pages into storefronts and convinced themselves they were building an empire. When prices fall, the empire becomes a liquidation sale. And this is where the story becomes the adult sneaker crash. Because sneaker resellers didn't just lose money when prices fell, they lost their identity, their social status, their sense of being ahead of everyone else. That's what's happening here too. The flippers weren't just making money, they were receiving validation. They were being treated like insiders. They were doing the look what I can get performance. When the market cools, that performance turns into silence because nobody posts their inventory when it's underwater. So why does 2026 feel like the year it truly breaks? Because the entire luxury hype economy is being hit from multiple angles at once. First, fewer marginal buyers. The easy money era is gone. Second, people are more cautious. Big purchases require justification again. Third, the flex economy is shifting. The internet moved on to new shiny objects, and luxury doesn't dominate attention the same way when everyone's timelines are filled with other dopamine machines. And fourth, the bubble itself created its own supply problem. The moment people believe something is a great investment, they overbuy it, they hoard it, they flip it, they treat it as inventory. That eventually creates the very flood that kills the premium. That's the irony of every hype economy. The rush to profit creates the conditions for the collapse. And now we get to the part that market majors viewers love, because it's a clean moral story. This is David versus Goliath, but the Goliath isn't Rolex the manufacturer, it's the gatekeeping system. It's the dealers who bullied customers. It's the flippers who taxed normal buyers. It's the middlemen who made everything worse, then acted like they were providing value. Normal people love watching that guy lose. The guy who laughed at you for wanting a watch. The guy who told you market price is market price, as if he discovered economics. The guy who said, if you can't afford it, just say that, while he was financing his inventory on a credit line. When that guy gets caught holding the bag, it scratches the same itch as watching sneaker resellers get wiped out, because it feels like justice. It feels like the product is returning to people who actually wanted it for what it is, not for what it could be flipped for. Now, if you're a viewer and you're thinking, okay, what happens next? Here's the realistic future. The gray market doesn't vanish. It just becomes normal again. Premiums compress. The most insane markups die. The guaranteed profit story dies. The inventory hoarders get cleared out. And slowly, the category returns to what it's supposed to be. Luxury consumption, not luxury speculation. And if you want the simplest lesson from this story, it's the same lesson as the sneaker crash. When a product becomes an investment on social media, it's usually too late. That's when the marginal buyers arrive. That's when the spreads are the most inflated. That's when the content is the loudest because everyone is recruiting. And that's when the downside risk becomes invisible, because the last 5 years of charts taught people that it always goes up. That belief is the bubble. The bubble is not the product. The bubble is the certainty. So if you're a normal person who just likes watches, the crash is good news. It means the most annoying people in the hobby are losing power. It means you might actually be able to buy something without paying a hype tax. It means the relationship extortion loses its leverage when customers stop playing. And if you're a flipper watching this video with your inventory list open, here's the harsh truth. If your business model depends on permanent premiums, you don't have a business model. You have a trend, and trends always end. Because the luxury bubble didn't pop because watches got worse. It popped because the story got exposed. The story was never, these are rare works of art. The story was, there will always be someone behind you willing to pay more. That's the same story as sneakers, the same story as NFTs, the same story as every hype market that pretends it discovered a new law of finance. And when that story breaks, the market doesn't care how beautiful the product is. It only cares about liquidity. And when liquidity dries up, the people who were acting like kings become sellers, the people who were bullying customers start negotiating, and the people who thought they were running a watch portfolio learn what a loss actually feels like. So yeah, the party is over. The gray market isn't cooling, it's deflating. The hype tax is getting sliced. And the best part is that you can watch it happen in real time, because the same guys who used to brag about market price are now begging for offers, pretending it's all fine, and quietly deleting old posts. That's the Great Rolex Crash. Not the end of Rolex, the end of the Rolex bubble. The end of a 5-year fantasy where adults convinced themselves luxury consumption was investing and built an entire ecosystem of scams around that lie. And if you want more stories like this, the ones where a whole industry gets exposed the second the easy money disappears, subscribe because the next bubble is already forming and the next crash is always louder than the last.